Good afternoon, everybody. Welcome to the Investors Business Daily November webinar, Managing Your Positions with Money Manager David Ryan. A quick introduction here. My name is Arusha Pierce, and I'm with the one, the only Scott St. Clair. And we have a very special guest. Welcoming back David Ryan. Once again, he's a three-time winner of the U.S. Stock Investing Championship, a client advisor and product developer for William O'Neill back in the day, and also, even more importantly, a portfolio manager for William O'Neill, and also of the New USA Growth Fund. Back in the late 90s, he founded Ryan Capital Management, and he's been featured in all these books below. So, David, thanks for joining us once again. It's always a great honor.
Well, thank you for having me back, and it's always fun to talk about the market, and always fun to talk about working with MarketSmith, a great tool that they'll see.
So here's our agenda for today. We are going to first start off with the market, and then we're going to get right into portfolio management. First, the rules, then we'll go over some examples, and then finally we're going to talk about a concept which is harder, especially for those of you who are newer to the game, buying back. And then finally, if we have time, we will go over a little Q&A and ask David some of your questions. Now, a quick disclosure here for all of you who have just joined. And so let's start off with the market. So here's a snapshot of the NASDAQ. This was taken probably a half hour ago. And I think this is a perfect example here of the trend is your friend, guys, right? I mean, this has been really honestly, this has been the best market I've ever seen. I've been doing this for 17 years now, actively studying the CAN-SLIM strategy, using a product like MarketSmith. And this market is just unbelievably resilient. And right now we have 7 distribution days. Your thoughts? What are your thoughts?
That's 7 on the
7 distribution on the NASDAQ.
On the NASDAQ, yeah. Well, what I'm seeing is I'm seeing a little bit of a narrowing. I think it's harder to find stocks that are really set up with good bases. And there are some stocks that are getting really hit on earnings. There's some things that are taking off on earnings. You can call it a landmine, gold mine type of market.
I like that.
Where you can either blow up or you've got this gold mine on your hands. So, but I think it's getting more and more selective. It's getting a little bit harder to find really good quality names that are there for buying.
Same. I think a lot of times when you're in this long of a trend and you have a stock coming out of a base, a lot of times I'll think to myself, and sometimes it keeps me out of a good stock, but I would think, why is it breaking out now, right? If XYZ is breaking out now and it's been in a really long base, where was it 3, 6, 9 months ago, right? So sometimes the later stage merchandise will break out last, of course. But you should already, in this environment, know where the leaders are, which are the names you want to be positioned in, and be positioned accordingly. Yeah,
I mean, I guess it kind of makes sense with the narrowing down. Now, obviously people have been talking about from 2009 on it, maybe we're 8 years into it, but if you take the shorter term where, say, just for argument's sake, that you started a new bull market in 2016, we're still like a year and a half, and so according to that, even there, you might have more of that narrowing down at this phase of the bull market.
Because I think if you look at, even at the MarketSmith chart, if you look at a weekly, there's a line there that draws your attention to a year and a half, because that's usually the average move of a bull market. The one other thing I would add is that even though I think a lot of people are getting very negative in here because you're getting these down openings and then they come back and stuff, it's really kind of interesting to see that even the housing stocks are starting to make this move. And so if things are really bad, what's going on with that group? And that's a very influential group. And I would always, in the back of my mind, I always go back to what O'Neill would say. He says, well, what is the underlying economy doing? And it seems to be fairly sound. I mean, it seems to be doing fairly good. But, we have to just watch the market. If you start seeing more and more stocks roll over, that'll just force you out of the market if you're using the right discipline.
S&P 500, here's a snapshot of this. And we have one distribution day on the S&P 500, and same thing, just a pretty strong, but you just have to worry about just a little bit narrowing, but like David said, let the market tell you. You want to kind of think about the larger concepts, but in the end, listen to the market. All right, so let's get into first the basics of portfolio management here.
All right, so one of the great quotes that Bill, and he has a ton of them, and they always make fun of me because I love Bill quotes, but he just has so much knowledge with these quotes. But the best results in our world, the best results in a portfolio is by putting as few stocks as you can stand and watching, what Bill says, watching that basket carefully. So rather than, diversifying over 100 stocks, we want to own 10 or 5 or 4 and kind of, in his words, know what you own. Know the companies, know the earnings, know the sales, and then watch those stocks carefully. And so if we're going to construct a portfolio from scratch, let's just use $100,000 as our target portfolio, and we're going to have 10 positions. Now, I'd like David to chime in here. Ideally, we'd want less, but sometimes, you can't sleep at night. So, if you can't sleep with 5 stocks, you got to, expand your horizon. And in this scenario, we'll start with 10. How do you feel about, a perfect, quote-unquote, portfolio strategy?
Well, if you go with 10 positions, I think everybody has to step back and ask themselves the question, how much risk do I want to take? Do I want to sleep at night? And for some people, I remember watching Bill and putting everything into one stock and being fully margined in one stock, and he didn't seem to have a problem with that. Where the average investor, or even myself, I would be in 3 or 4 or 5 stocks when I was really concentrated in non-margin and really getting aggressive. So you have to ask that question. I think the other thing you also ask is, where are you in terms of age? In your 20s and 30s, you're going to be working for another 30 years, and you can be very, very aggressive. But as I've found, as I've gotten older, I've gotten maybe a little bit more conservative because I don't want to lay it all out there on the line. So you have to kind of see where you are along those 2 spectrums.
Sure. And so just to make the math easy on myself, to be honest with you, I chose 10. And so if this was your portfolio, your starting position is $10,000. So this makes it real easy for you. Every time you're going to have a starting position, your starting dollar amount will be $10,000. So when you go to buy XYZ or whatever, you just get your calculator out. Now, how we do it is with our, the pyramid strategy, and we'll go over that briefly here. You start with half of a position. So in the scenario I've created, the very first buy is $5,000 worth of stock. And in this day and age, it doesn't matter whether it's a $300 stock or a $3,000 stock. You want to buy it as close to the pivot as you can, and you can buy 12 shares, 8 shares, 2 shares. The world is different. They don't have the odd lots like, when I first started as well. So you just buy as close to $5,000 worth as you can in that scenario, half your position. If the stock starts to move, if the market is telling you that so far you're right in your purchase, then you add another, roughly 30, 35%, 2 to 2.5% above that pivot. So if I buy it at 100, I want to buy more at 102 or 102.5, somewhere in that range. And then last but not least, I'm going to top it off around 5%. So 100, 102.5, and 105. And I'm buying less dollar amount each time along the way until I've got my whole position. And so let's play it out here with 10,000. My first purchase is 5,000. My second is roughly 3,500, and my third purchase is $1,500. And the reason we do this is we want to let the market tell us that we're right rather than the other way around. Like, I really like XYZ. Let's put 30,000 in that. And 2, if we're wrong, sometimes you can be wrong like initially right away. Has that ever happened to you? And,
yeah.
People will always ask me at seminars, do you ever, sell a stock the next day or the same day? And I say never on purpose. I sell it because I bought it bad and it turned around really poorly on me, right? Yeah. So if you do this, if you buy it wrong and it goes bad real fast, well, now you have a loss on half the position. So it kind of keeps you in that protective mode as well. So let's start with stock. This is Priceline in 2011. And $5,000 worth as the stock comes out of the space is roughly 12 shares at that price, right above the pivot.
One thing I want to point out, see how the stock has actually already made a really nice move.
Yeah.
But then builds a whole new base. And so you shouldn't get upset that, I missed this stock. if it's a really strong stock and it has all the canceling characteristics, just mark it down and look at it every few days or every day and see, hey, is a new base setting up, and then you can get it on the next move.
It's so funny you said, because I have a lot of the tapes from the webinar or the seminars that you used to do all the years. I have a friend that gave me a bunch of tapes that he put on CD, so I listened to those a lot. And one of the things that struck me that you said, almost all of them, was I like to buy stocks that have doubled, right, because they tend to double again. Right. So I use that on the road. When I go on the road and talk, I say, Dave Ryan, he likes to buy stocks that have doubled. Now, you're not buying them after they've doubled, of course.
No, it's after a new base.
Yeah, and that's almost perfectly here where Priceline goes from 200 to 400, doubles, and then builds a base. So somebody asks, do you make your second or third purchase if the price moves against you? No, not in our world, absolutely not. And so if this stock turned around immediately and the next day it was 400 and I was down 6%, it wouldn't be any fun, but we'd be blowing it out.
Yeah, just to go over one other point that David was making here. Now, the stock goes up on a huge run. Now, I remember when I was starting out, I would see like a price on it. Oh, man, I missed this. How could I not buy it? And then I'd forget about it. And all of a sudden, it'd form another base, and I missed the next breakout. And because there's so many stocks moving and flying around and stuff like that, now the nice thing is, if you don't have a lot of time, especially with a market smith, you can just go right to the near pivot. And if the stock is a great growth stock, it's forming a new base, it's just going to appear there. So if you want to simplify your routine, you can just go right there and then eventually expand it.
All right, so the stock actually advances the next, and sometimes you can complete your whole purchase in the same day. Sometime in a really good market, you might complete it in hours, right? In this case, your second purchase, the stock advances, and you buy 8 shares at $438.70. That's roughly 2.5%. And so this is where it gets a little interesting. You've got 2 trades. You've bought 12 shares at $428. You bought 8 shares at $438. And, talking to David about this, there's 2 ways you could do this to protect your capital. You could create a stop on each individual trade, or you could average the trades and get a stop. But either way, you want to have some plan to get out.
Yeah, you always have to have something before you go into the stock. Set a stop. And because you're making that decision when you're not in it and it's not getting emotional. Yeah, the other way you can do it is you can average. Here you have a 7% stop on some of the shares, but what I do is I usually take my average cost and I put a 4% stop on half of it, and then maybe a 6 or an 8% stop on the rest of it, so that averages out to a 6% loss on that stock. And if you bought it correctly and the market's good and the stock's good, it shouldn't come back down as far as 8%. Sometimes it can come to 4%, but there's a few different ways that you can do it.
And I really like your strategy because of the fact that we're human, and the mental makeup is easier of just 2 small losses that add up to the same amount versus a larger loss that's 1 trade, and it just kind of tricks you into thinking, well, I can stomach losing this amount, and I can stomach losing that amount. But when you combine them together, sometimes that amount seems too large, and it causes you to hesitate. So you've got a plan to get out, and we'll talk about another strategy later as the trade plays along. But you can see sometimes they pull back, and this stock pulled back in this case. It never quite reached either stop. So if you had the dual stops, you're okay so far. If you have the average cost stop, you're okay so far as well. And then a handful of days later, you complete the trade. You buy 3 shares at $450 roughly, and now you have your position. And at this point, you what? You do nothing, right? You've got your position. You've got your $10,000 worth, and you just want to give the stock room to breathe. Give it a chance to see if it can work.
And that example there is an example of what a lot of stocks have done over the last couple of years, where they break out. They go up a couple of days, and then they come back and they pull back on top of the previous base that it just broke out of, and then it starts going. So there's a lot of starts and stops these days to some of these stocks.
Yeah, and it's tough. And the nice thing here with this is you would have only made 2 purchases. I have to think, if I had made that third purchase and then it had come back down below the 425, it probably would have gotten some of the shares from me. It would have knocked me out of the box a little bit there.
But the nice thing about that is it allows you to ebb and flow, right? You're not completely getting out because then it makes it a lot harder to get right back in again.
All right, so here we are on the weekly chart. You've got 23 shares at 434, and we've just done, here's your average cost stop at 7% at 418. And so let's advance a handful of weeks. And now this is the toughest part, I think, when we talk to people is, okay, now what do I do, right? It's a great problem to have. I wish I had this problem all the time, but it's a difficult decision. You're up 20%. Do I close it out? Do I take some? You know, if I take 20% every time, I'm never going to have a big winner, right? I don't know how you could do that, but if you're always getting up 20%. So sometimes you want to try to hold on and have a big winner. Your thoughts on this, David?
Well, Bill always had that rule of if you have one stock that goes up 24, 25%, that you could have 3 losers and 1 winner and still come out ahead. But I think the fact that this really looks like it's starting to accelerate, that you'd probably want to hold on to it for another, maybe another 8 weeks because it looks like you've gotten that much in a short period of time. The other thing you can do is move up a stop. You can trail it by using a 50-day moving average. If you're already up 20%, then just put your stop at the 50-day or maybe just slightly below the 50-day. And then as the stock keeps on rising, you just keep on moving it up with that 50-day moving average.
And that's where your 50-day is on this chart. So in that case, your stop would be 457, and that would lock you in with, the worst case scenario, at this very moment, if the stock just came unglued, a small profit.
Yeah.
Which is, now you have, you're working with the market's money.
Yes. And then the other thing you can do is you can move it up under the last previous base, or there's maybe as we go on in the next example, we'll see other spots.
Well, one thing, and here's price line on weekly. One thing that you talked about earlier that I forgot to mention is, also the company, right? And their earnings and sales and all right. So now you're up 28%. You mentioned earlier, if you have to know the company and what are the, and Priceline was big earnings and sales, et cetera, at the time.
Yeah, I think this is where you really have to start digging more into the fundamentals. If you want a long-term move in any stock, you've got to know it, and you've got to know it really well. And what is that key concept that's going to keep this thing going? And that will help you through the long run, and also keep you in a stock that you might get shaken out of. So, when you look at Priceline and where they were in terms of just dramatically changing the travel market, that gives you more conviction to stay in something for a longer move, especially if it's not doing anything wrong technically.
You mentioned and we often mention it about Bill, what you said, changing the way we work, live, or play, right? So if you can say that about the company, that can help give you some confidence to hold on to it. And now a number of weeks later, it's pulled back a little bit, and that red line is the 10-week moving average. And it looks like at a point it was underneath that during the week, but it closed almost unchanged for the week. Let's go to the daily so we can really highlight the action. And this is where I was curious what you would do, David. The reason I've highlighted it here, the stock undercut the 50-day for, it looks like a day and a half, rallied, and then another undercut where it's now under the 50-day for a number of days. So you mentioned your 50-day stop-loss strategy. Is that, immediately? Is that a close? How do you handle it?
I usually like to see it on the close, and it looks like it looks like only one day you really had a problem where the stock looks like it closed on the low of the day. But even if you had pulled up your stop to that 50-day and you got sold out at 500, you still had a very, very nice profit. Now, again, going back to how well you know this company, if you know this is a great company, then you don't have to sell your whole position. You can sell half your position, take partial profits, keep the other half in. Because one of the worst things you can do, and I think a lot of people have done it this year, I've done it numerous times this year, where I get shaken out, I get sold out of a really good stock, and then it takes off and goes, and I'm no longer in it. So you don't have to do all or nothing. You can sell part of the position, and then hold on to the rest, and maybe move up a stop on the rest of it. See if it builds a new base. If it builds a whole new base, then you can go back and buy the position that you sold.
And you talked about it a lot when we spoke earlier about the mental capital, and it's much easier to buy a stock that you already own at a higher price, right, than initiate that position.
Oh, yeah, because yeah, it's very, very tough mentally to say, oh, I sold a stock at 500 and now I'm buying it back at 550. Because you're going, I gave up 50 points. Well, if you still had some kind of position, it makes it a lot easier to go ahead and buy it. And then I think I mentioned that if I completely miss the stock or it takes off without me, I do what I buy. I call it a mental health buy. Just enough. Maybe it could be 10 shares. It could be 100 shares. So I'm back on the side of that stock and I'm not unbalanced in my thinking and I'm a little bit open to the next idea.
Yeah.
And then sometimes it can actually move into a larger position if the stock moves up, builds a base, and I'm in it. So you have to keep yourself, mentally stable and looking for new ideas all the time.
All right, so let's get into a portfolio. So that's how we initiate positions and a little bit of how we get out of positions. And now managing a portfolio is, a lot of ebbing and flowing with the market. Peter Lynch, who had a great track record running Magellan, love his books too. I really like his train of thought, but he says you don't want to cut your flowers and water your weeds, right? In essence, you want to put more money into the stocks that are working and less money in the ones that aren't. So here's a quote-unquote typical portfolio. So you have these 6 or 7 stocks, and here's your largest position. It's DUD, D-U-D, and you're just certain. Your neighbor told you this is going to be a huge winner. They've got this new drug coming, and you just pile into it. So it's 26% of your portfolio, and the stock has gone nowhere so far. So that's really a no-no in our world, right? We want to let the market tell us what's working rather than what we think should work. You also have these 2 trades that are really in reverse. So your stock hero is your biggest winner. You're up 65%. You've done great in this stock, yet it's a tiny position and it's only 10%. And the gain that you've made in that is offset by a larger than normal loss in zero, right? Your abnormal loss of 12%. If you had cut that at 7 like we do, you could have saved yourself a couple thousand, some heartache. And also, you get that off the books, right? Have you ever stared at a stock all day? And I tend to, in my portfolio, if there's 7 stocks, I always seem to watch the ones that aren't doing well. I'm hoping to will them higher.
Yeah, I maybe this is not the greatest term, but when I have a loser in my portfolio and it's in there for I actually can't stand having losers in my portfolio. To me, it's like a cancer, because if you let that one go and you let it go through your stop loss, then you'll let other ones go, and soon your whole portfolio is a real mess, and you're looking at a lot of losses. When you look at this typical portfolio, you have to say that being disciplined in buying the right stock at the right time also goes towards your portfolio. You have to be extremely disciplined in your position sizing, and so that's why it's so important to start out at a certain size and then add to it as the stock starts moving up. And this right here, to me, is just a mess.
Yeah, let's hope that nobody has this type of typical portfolios. This is an exaggeration for sure, but we want to highlight some of the common things that and we're all human, and I have to admit I've made some of these mistakes for sure, that you just want to kind of get out of this habit. So when you look at your portfolio, you really want to sort it by percentage of portfolio, and in an ideal world, in a perfect world, it's not always going to look like this, but it should look very close to this, where your largest position is also your largest gain. And in this case, you don't have that 12% loss in your portfolio. That should be gone. And if the stock rights itself and builds a new base or comes back, you can always buy it back. But this is how we really want our portfolios to look.
Yeah, and I would say that also that, as you mentioned, your largest position should get that way because you already have some profits in it, and maybe you have bought it a second or third time coming out of additional bases. So to start so big, is not an ideal portfolio. I mean, let's say if you're only going to be buying 4 stocks, okay, yes, you start out with a 25% position on each one of them. But then for that to become, one of those to become a 50% position, you need some capital gains and also maybe new bases to add to it. And money's always, you want your money always moving into your best performing stocks.
All right, so let's look at a trade that David has done this year, Control Corp, CTRL. And this is the initial breakout. This is where it first started to appear on our radar. I didn't know of Control. I had no idea of this company at all. And then it appeared this day breaking out of this space.
Yeah, now this is a stock that I had been watching for a long period of time because back in 2016, I actually put a Control 4 system into my house. I was not satisfied with the system I had before, and so I put this in. I was very excited about using it. I can turn on the TVs. I can turn on the music within the house just from my iPhone. One day I was down in Orange County, and my wife wanted to hear some Christmas music. She says, "How do I turn this on?" And I said, "I'll take care of it." From my iPhone in Orange County, I was able to turn on the music, Christmas music in Malibu, California.
You should have turned on like some hardcore rap or something.
Oh, I did.
It's just a trigger.
I know. Yeah. So I like the system, and I try to almost make that a policy where almost any product I buy, I try to find, is there a stock associated with that? And if it has all the some characteristics, then I'll find a way to buy the stock. Now, so I didn't buy this on this initial gap. I hadn't been in it, but we had that real nice big gap, and so I started watching it very, very closely.
And then so it gaps up and very powerful breakout, and then you also have, if you missed it, it's going to show up in what we call our Power from Pivot list. And basically that's the list of stocks that advance 20% or more in 3 weeks or less. So like you mentioned before about if it has a powerful move. And
why didn't I buy it on this huge gap up? Well, the stock was already fairly well extended before, at that point. So trying to be disciplined. I don't want to buy anything more than 5% out of a base. And so I had to patiently wait for the next base to build.
Now, just to touch base here, this actually appeared on a few of the MarketSmith lists. And one of the goals with these lists are you don't necessarily have to buy it. So the first list where I started seeing this stock coming through was the MarketSmith Breakaway Gap Report. And you don't necessarily have to buy it here, but at least now you're aware of it. You can prepare. You can do the story. You can find out how cool the systems they have are installing. It also appeared in the RS Line new high screen. So we're doing all of these things to just get these stocks that have potential on your radar as early as possible. And then here, once again, now if you missed those two, once again, here's a reminder. Power from Pivot. Now, these are stocks, and David mentioned this a little bit before, where, Bill, for some of the stocks that Bill would hold, and instead of selling at 20%, when he had a rule, if it was up 20% in under 3 weeks, he would, if it was a great story, a game-changing story, he would try to give it a full 8 weeks to try to hold through that first pullback. We created this Power from Pivot list to try to identify stocks that are displaying that type of action. So here was another reminder that, hey, Control is acting so powerful, take another look at it.
And what I would do at this point is, the great thing about MarketSmith is it's designed, as you said, to find these types of stocks. I just pop it into one of my lists. I take, I call it 2017 watch list. Just hit a button, it's in that list, and then I go through that list every few days or maybe even every day so I don't lose track of some great winners or potential great winners.
Right.
And so this is the daily chart on April 19th. This is the day that you initiated your position.
Yeah, and you can see the stock built about a 6-week base, and it started moving through there. The volume picked up. You can, as you look down at the bottom, you can just look at the color, and you can see that the big spikes to the upside are all in blue, and those are positive days, big volume as the stock is moving higher. When the stock is coming down, it's in red, and there's not much selling.
I mean, it's funny how obvious, when stocks become huge winners, how obvious they are. Looking back, it's like all those signs.
Yeah, when we can all be geniuses,
right, exactly.
Doing post-analysis on these things and look like heroes. But it's a lot harder when you're going through it and living it day by day.
This is the weekly chart of the week that the position was initiated. All right, so this is a great chart. I love this. So you buy it at 16, 17, and then you just sit patiently because the stock's done nothing wrong, right? Yeah. And then it comes out of this consolidation / it might be a little deep to be a flat base, but comes out of that consolidation area, and then you add to your position.
Right, and what was it Jesse Livermore said? It's the sitting that is more important than the thinking. Sometimes we overthink our positions and we go, well, maybe it's going to correct or what it's going to do. But sometimes you have to play dumb, and you just have to say, okay, is it above this 50-day moving average? Is it above my 25-day moving average, or whatever it is? You just have to sit and let these things go. And so, you could there was even a smaller base at around 21 that you could have added to a little bit there. I don't like really short bases. That's like maybe 2.5 weeks, 3 weeks at the most. But I like 6-week bases. That's kind of old school. It seems like now people are saying 4 weeks is fine. But in a strong market, you can get away with shorter bases. But shorter bases usually have shorter moves. So anyway, that's the second buy point.
And this is classic how Bill did it and how David does it. When Bill bought Amgen in 1991, he would buy it on numerous days, spread the buying out, and it was over, as the stock advanced. So, you were probably here when he was buying Amgen.
Oh, yeah.
Were you here?
Yeah.
So you lived it, and I've heard stories that he might have thousands and thousands of shares and literally just go buy another 100 shares because he wants to put more money into that.
Yeah, well, he would talk with the CFO to see if what his buying power increased by the previous day, so he could know how much he could buy the next day.
Incredible.
So.
And then here's control up to date. This is yesterday's chart, I believe. And one of the things besides the patience that he had, which is I wish I had, because I bought control right around the same time as David. In fact, I will even admit I think I got a better price than David, but I promise you he's done way better in it than me. And so getting the best price isn't always so important. It's how you handle the trade. I got impatient with it and just felt like it wasn't really going anywhere. It was just shocking that a stock that went from 16 to 32 you could get impatient with.
Yeah, and you can see that it's still hanging above its 50-day moving average. Yes, it came through it a few times, on a day, but then the next day it was right back up. And so the stock continues to do well.
And I'm sorry, David. The one thing that really that stuck out to me, and I've highlighted here, is you've sat through 3 quarterly earnings reports in this stock, and that's the most common question we get when we go on the road, when people call, is what do we do during, earnings? It's the number 1 and number 2 and number 3 question.
Right. Well, if you're not going to hold through earnings, you're going to miss some of the biggest moves. And these days, it seems like some stocks tend to move only on their quarterly earnings report days. And it's a lot easier going into an earnings report if you already have a profit. That's one thing. It's nice to have some kind of cushion. There are other strategies you can employ. You can buy puts against the position. You can sell calls against the position to buffer some of the downside. So there's a few things. You can also sell part of the position and wait until the earnings are reported. And then even after the close, if they're reported after the close and the stock gaps higher, maybe you can, and it's not too far out of the base, you can go ahead and add back to your position or buy more.
Now, David, it looks like Robert's asking, do you have like a threshold here of you have to be at least up 5% going to earnings, 10%? Do you have any kind of percentage gain that you want going into earnings?
I would think I'd like to at least have a 10% cushion going into earnings. A lot of that, it also depends on the volatility of the stock too. So So you can look at it from that standpoint too. If it's very, very volatile and you've seen in the past it has huge gaps up or down, then you might want to either buy some puts to help cushion the drop if it comes in.
Okay, and then David, Brian has a very good question. So you buy a position at 16 and then you add at 25. How are you sizing those positions? So what's your position to start, and then how much do you add? Do you treat it as a new buy? Can you talk to us a little bit about that?
Yeah, let's say, okay, well, going to where if I buy 10 positions, my first position is 10%. And then it has a real nice move up, and so maybe now it's a 15% position because I've got some gains in it. Well, if it builds a whole new base, to me it's a whole brand new stock, and I can buy, I can double the position if I really feel that strongly about it. It depends on how big I want to get that in my total portfolio. So if it's a 15% position, maybe I really want to play this out. I'm going to move it up to a 25% position, or maybe even a little bit stronger. So that's kind of the way you add to it. But it's a brand new position once it builds a new base and it has all the Samsung characteristics.
So the pyramid strategy is for that initial purchase. We want to get to a position, and after that, if you want to buy, do you ever buy off a moving average? Do you ever buy off the 10-week line?
Yeah, sometimes if it pulls back and you get a day where it trades down and then it comes back up, that's a way you can do it. But I like them. I like them coming right out of that base, a nice long base.
Okay, let's go into another example here. Yeah, this is a stock that David spoke about last time he came in late January. And if those of you who put this on your radar and bought out of that next breakout after David spoke about it are probably pretty happy here, Ollie. So here you go. This is back in November 10th of 2016. And this is where you initiated your position.
Yeah, great long base. I mean, that's one that looks like it's a 6-month base. It had all the earnings. It had all the Samsung characteristics. And as it pops out of there, that's where I initiated the position.
And David, just to add something here, so you have the breakout. You also, if you look right underneath the price pattern, we have this little blue dot. What that's signifying is that the relative strength line is hitting a new high while the stock's breaking out. So it's not only telling that, yes, the stock is breaking out, this stock is becoming more of a leader in the market.
Yeah, I think one thing that's important that they understand is that the relative strength line is against the S&P 500 average. The relative strength number is against all the other stocks in the market. And I actually key off the line much more than the number. I mean, sometimes I do screens based on the number. It's generally... But when I'm looking at a chart, I really look at that line because I want that line to be outperforming the market. I want it to be going to new highs as the stock's going to new highs.
And honestly, this is why we added this blue dot in here to remind us, because when we went back and looked at a lot of Bill's old markups, he kept circling this line as it broke out, and we could never remember it, so we just had the programmers program it in for us to remind us.
We've added the initiated, and then this is where David added to it, but I've highlighted a certain area that I found intriguing. This, obviously, the box in red where he sat through this space. And that's a big deal. He made the quote about Livermore sitting, and I just wanted to get your thoughts about sitting through that base after initiating that position. How do you handle something like that?
Well, it didn't get up that far from my initial purchase. It looks like it got up to 10%, then pulled all the way back. And so it pulled back down on the previous base, like I had mentioned before. That seems to happen a lot. So I wasn't up that much, so I really couldn't take a profit. But the fact that it got support on that previous base, even though it went through the 50-day, then I continued to hold on to it. And then as it came back up, built a whole new base, then I could have added to the position. I might have even added to it 2 weeks before this, because that's where it looks like it came into new high ground.
The spike that looks like it got hit, it pulled back a little bit intraday. Yeah,
probably right in there. And you can see the relative strength rating, or relative strength line, also hitting new highs as the stock is going into new highs.
Again, and this is perfect, classic how you want to do it. He buys it, and then he adds to it 5 months later. Whereas sometimes I'm my own worst enemy, and I buy it and I add to it 5 minutes later because it's higher by 50 cents. And this is just such a great trade.
Yeah, well, everybody wants to have that big winner and do it all in a few days, but I think it's best incrementally, made over time, compounding over months and over years is where you can really do well.
Yeah, I mean, this is so beneficial for me personally because what you're describing is that a lot of times this year especially, I'd be a little bit more aggressive and not given as much time, right? So just hearing just kind of the true CANSOM strategy is really, really good for me.
And let's advance to Ollie. This is yesterday I took the screenshot, and one thing that David mentioned. So you see how far the stock has advanced,
right? And
you've noticed. You mentioned the line, how important the line is for you, and that the line is starting to weaken, which is kind of your spidey senses are going off. Right?
Yeah, and so I've actually reduced this position down dramatically. Because you're starting to see some pickup in volume on the downside. A few of those spikes, you look down near the lower part of the chart, you'll see the volume and the red line going through the volume. And then some of the volume spikes are now to the downside, which is not good. Also, you can see the relative strength line is starting to form a downtrend. And then also the last time they got the stock 2 weeks ago, got very, very close, almost went into new high ground. The relative strength line was lagging. So there's some subtle signs that saying, this is not as strong as it used to be. I'm going to cut down on the position. I still love the company long term, so I'm going to cut it down, way down to where, as it goes, hopefully just goes through, builds a whole new base. They have earnings in early December that I can hold through that. And then maybe buy some more as it goes into new high ground. But I'll cut it back because it's giving me warning signs of it's not as strong as it once was.
Okay, so let's go into our last example for this section and one of the best stocks of this year, Square.
Okay, well, this is the initial breakout of Square all the way back in February. Now, I didn't buy this. You'll see where I bought it.
Yeah, and if you didn't buy it here, once again, though, this is what's nice about our algorithms running through the database. It appeared on the breakaway gap report. You can see the pattern recognition forming that flat base. I think it reported earnings at this point, massive gap up, and so at least it got on your radar.
Okay, so then this is I guess it's the next
It formed another base at this point, right? Another flat base appearing in the breaking out today screen, and also there's your blue dot again signifying an RS line hitting a new high. So you're just getting multiple reminders that, hey, this stock continues to outperform the market. Maybe take a look at it again.
It's a little higher, Rusha. It's gone from 12 to 18. I think I'll wait for it to pull back.
You're waiting.
I'm still waiting.
Yeah.
There you go. There it is. You're waiting.
Okay, so I think this is where I finally realized, hey, this stock is doing well. I bought it on the breakout, and I got shaken out. And then maybe it was general market. How many times have you guys bought stocks, got shaken out, look back 3 months later and going, what was I thinking?
It's like every day.
It's like, you kind of go, wow, did I have a moment of just weakness and I just couldn't stay with my discipline?
It's unbelievable.
And the market's doing this and that. It's so good to try to step away and try to take a very unemotional view. But I got shaken out as it went through that 50-day. But really didn't do much. The earnings, it's got all the characteristics. Look at the earnings coming through and the sales picking up. Stock formed another base and now has taken off. Look at it, it's gone from 29 to 40 in the last 6 weeks.
So one thing I found is it's shaking out, and probably in that scenario, if you own 8 stocks, they're all doing the same thing pretty much, right? Do you find that most of the stocks we own are, like today, all my stocks, I think I have 7 of the 8 were down, right? It's just going to be like that. I had a plan to buy XYZ, if it pulled back to the 10-week line. The first time it touches that 10-week, I'm buying that stock. I can't wait to add to it, and then I'll never forget the day that it hit the 10-week line, and I was getting killed in the market that day. Not only that stock, but the other stocks I owned.
Right.
And I lost my nerve to pull that trigger, and then the stock, did exactly what I was hoping it would do. It rallied back and rallied really strong. So how do you avoid something like that? And then if you make a mistake, it's okay. Then what's the plan to fix that, to get you back into something like that?
Well, I mean, you keep an eye on it, and maybe you could have gotten it, maybe 6 weeks ago, right below 30 at, I guess, 29 when it came out of that little base.
Yeah, it looks like kind of a cup with high handle, right?
Yeah, it didn't look perfect, but it was a great spot because that's where the move really started taking off. The other thing, and I might have mentioned this before, the most important thing that people can do is every time they buy a stock is screenshot it.
Yeah.
Screenshot it, put it in a file, write notes on it. I even have a notes program where I just drop the chart into the notes and I write below, why did I buy it? And you hold on to that, and then you go back and months later after you sell it, you do that post-analysis. I mean, you also screenshot it when you sell it too, because then you have to go back and see where you either were right or were wrong in that situation. That's where they'll learn more about themselves and about what to do in the market while working with Market Smith and working with this discipline than just about anything we could tell them.
And one thing about doing that is you capture all that data, right? So if I go back in 10 years and say, well, Square, look, coming out of this space, I'm not going to know what the earnings, the sales, like what the proprietary ratings were, but by printing it or screen capturing it electronically, you get all that data so you can see, what all that was. Everybody calls and wants to know. I would love to know what was Apple's relative strength in 1997, or its composite rating or EPS rating. Well, we don't have it, but you can start keeping that now by going forward.
And so here's Square on a weekly chart, and that's where it appeared in the breaking out today. Screens, and you can see the breakout, and this is monster run. And David's mentioned that relative strength line a number of times now. Look how sharp that is. I mean, just keeps outperforming. Just when you think that it's done running up, the best ones continue to keep going up.
I think Square was up today. The market was
every market was down. Square's up.
And that's the funny thing is the strength begets strength, right?
Well, they made an announcement. I think that you can buy Bitcoin. With Square or something. Yeah.
So that's like adding the .com in 1999, right?
It's like throwing gasoline onto the fire. Anything Bitcoin these days.
Okay, let's go over our last concept here, buying back, because as hopefully all of you on the webinar know, getting shaken out is part of the game. Okay, but where it's going to make the difference is, can you get that nerve, can you get that strength to actually buy back, and fight your ego?
So, here's a couple of great stocks this year, Lam Research, this is the first one. And one thing I've noticed, and this is something you guys should be doing, go back and look at all the great stocks in 2017. In fact, do a screen. What were the best performers in 2017? And why did I miss them? What was there that maybe didn't catch my eye? A lot of times, for me, it's that the first time it didn't work, and the second time I kind of lose my nerve. Sometimes I can pull the trigger the second time. I have a hard time the third time. They usually get me by then. But you can kind of see with this stock, if you bought it the first time, it stopped you out, and the second time was great. And then it did the same thing again this year.
Yeah, one thing I would mention too is if the stock is actually building another base right now. It's been going sideways for about 3 weeks.
Yeah.
So this is one. You missed it once, you missed it twice, but maybe we'll have a third chance to get aboard this stock.
Tesla, another one, breaks out, pulls back. If you bought it, you got stopped out. The next breakout worked. You made at least 20% in that move, build a new base, breaks out, stopped out. So this is the reality of the stock market, right? Bill would say, welcome to Wall Street. This is what happens.
Right. I think the most important thing to learn from this is that you have to take your ego and throw it into the trash can when you're coming into the market day, because the market doesn't care what you did past in this stock. it's going to do what it's going to do, and you have to adapt to it.
And then ANET. And these are just a few examples. That if you go through the database and look at some of the big winners, they all kind of tell the same story. Breakout, shakeout, can you buy it back, another breakout. And one thing about a lot of these names, besides Tesla, but the Lam Research, is the quality of the company, the earnings, the sales, the return on equity. They're all super, super high. On
and I mean, this consistently came up through the Marcus Smith screens too. I mean, this is not it's always a shock that it goes up this much, but it has throughout the year. ANET, all these stocks.
One thing you'll find, and this is something, an important detail, but something to look for in a stock that's in a good, strong uptrend, you will rarely, if ever, get 3 weeks down in a row. Oh, and I'm not talking just little minor 3 weeks in a row, but 3 fairly large weeks. You can even probably, if you go to the daily on this and some of the biggest winners, you rarely ever get 3 big days down in a row.
Wow.
So the strongest stocks, they don't pull back much. They just keep on going up, and you don't get a whole lot of weakness. I mean, if you look at this, I don't really see 3 weeks in a row that we're down substantially at all.
And you can see the number of funds, the 443, 479, 623. Those are the guys that are doing that. And you must have worked with a lot of institutions when you worked at O'Neill.
Oh yeah.
Tell them a little bit about
how we're on the left-hand side. By the way,
sorry,
if you're looking at you can see on the lower left-hand side, right above the quarterly earnings and sales, those percentages. There's a number of funds section.
So how do the funds buy versus how you and me buy?
The funds are buying 1 million shares or 3 million shares, and so they can't get it done on one day. They buy over a number of days in a row, or they wait for some pullback. And sometimes if they get a 6 or 7% pullback on a stock, they're going to go, hey, this is our chance to increase our position, and so they add to it. And that's why it really doesn't pull back that much.
The 3-day rule right there, because you see that fund manager, he's watching this stock, and it's down again, and by that third day, he's just anxious.
Yeah.
And then he goes in there and starts buying it, right?
And on every Marcus Smith chart, you're going to get that fund information right there. So you get to see if there's true institutional sponsorship or not.
Align, this is a beauty, another great one. First breakout didn't work. Second breakout, well, I won't buy that. I've got a loss in that previously. I think I'll pass. And strong ego, weak judgment, right? 100 to 230.
Yeah, you see how many weeks in a row that stock was up from the second breakout?
I don't want to look at it anymore.
I may count that high.
13 weeks in a row.
Yeah, exactly.
I'm guessing, but that's as Bill would always say, that's not your Aunt Sally down the street.
So true.
This is huge institutions, mutual funds, and hedge funds.
And I'll tell you, I mean, once again, this was one of those stocks that just kept flashing and flashing. And I remember thinking, how many people really need the Invisalign product? Well, apparently everyone is using it, and the age groups are increasing. And so if you really know the story, now you're starting to see that it's flashing across these Marcus Smith screens. You're going to get that much closer to capturing one of these monster stocks when you're in a great environment like this. Okay, so David, you mentioned a few times during this webinar that you're a Marcus Smith subscriber. Could you just give us a little bit more idea of how you use Marcus Smith in your routine to find some of these ideas?
Yeah, well, every week and even every day, I'm either going through my lists, I'm going through screens. The greatest thing about this is that it's designed with this can slim philosophy in mind. Everything on that chart is important. You can go through can slim right off that chart and get all the characteristics you need. So it's really one source to find all this great information. And so through screening, through lists, it's hard not to be able to know which ones are the leading stocks in the market with these characteristics. Then it just comes down to you having enough discipline to buy them at the right spot and buy the right size, as we talked about position sizing.
So for those of you who are interested in trying out Marcus Smith, we have a special offer. 4-week trial for just only $29.95. And for those of you who are new, we're going to make it even easier. You get the How to Make Money in Stock Getting Started book by Matt Galgani. It gets right to the most important points that you want to get down first when learning how to invest, especially with our strategy here. What's nice about this, David was highlighting some of these consolidations that he was buying out of and stuff like that. If you're new to it, you get pattern recognition. You get the Growth 250, which will tell you what stocks are setting up, what stocks are breaking out. That's all included in this 4-week trial. So if you're interested, there's the information there. Now, for those of you who are experienced, you get access to our MarketSmith screener. It has over 100 criteria that you can screen from through over 5,000 stocks in our database. So you can cater it towards any style you want. Now, once again, as David mentioned, the whole MarketSmith platform is catered around the CAN-SIM strategy to find the best growth stocks possible in the shortest amount of time.
All right. So do we have time for questions?
I think we have a little bit of time for questions. I just want to make one quick announcement. Right. We've had a ton of questions. Thank you so much for it. There are a lot of technical questions out there. We haven't had a chance because they're a little bit more in-depth to get through them. So what we're going to do is we're going to answer them over the next day or so, and we're going to put it right on the website, okay? So everyone could, go and check it out there.
All right, great. Susan had a great question. If you're using the pyramiding and the stock, gets away from you, how do you handle that? So let's say it's a $100 stock, and it's now 105, and you wanted to buy it at 100. What do you do in that situation? Do you just buy a portion? Do you just put the whole thing in there?
Well, yeah, if you've only gotten half your position bought, and then it just gets extended.
Yeah.
Well, then I would wait. Maybe you'll get a chance. Maybe it'll pull back in the next couple of days, back close to your buy spot. But sometimes they'll just take off and go. It's just your risk increases the farther away you get from where your pivot point is or where your buy spot is. So, just be patient. Sooner or later, you'll be able to add to that stock, even if it's 20% higher. It's safer.
And that's one thing that really hit home for me here is that it's never sort of too late. Like for the CTRL, I was in there at 16. I didn't handle it very well, and there was another chance at 25, and then I just couldn't get over that. No, it was 16. Now can I pay 25? Right?
Yeah.
And so, but if it's going to go from 25 to 35, what does it matter, right? Just pretend it's a whole new company. Do you ever use industry group allocations? In other words, I'm way overweight biotechs, therefore I want to reduce that. Do you ever look at that in your portfolio?
I guess I don't want my entire portfolio in biotech, but if that group is one of the strongest groups, well, I want it to be one of the biggest weightings in my portfolio. So
semiconductors, the last 6 months have been a great group, so you can have more than one name in that group, right?
Yeah. But then I actually look at lots of times I sort my lists or I sort my screens by industry group because I want to be buying. I think most of the best moves occur when it's in the top 50 groups, if not the top 100. As you start getting farther and farther back, then you're not going to get that group strength where you can get some big moves.
And the Growth 250 is sorted by industry group ranking. So you have the top stocks within the top industry group at the top of the list. And that's done on purpose because of, that's the CAN-SIM strategy there.
Yeah, when I go through like the Growth 250, I sort it by top groups.
Okay, one more question.
Last but not least, okay, so there's daily charts, there's weekly charts. Give us your thoughts on the difference. So is there one better or one worse? What do you think of that?
I think I like to start at the weekly picture and then come down to the daily. When I was here, before I was showing Bill daily graphs, this is the old product, daily graph charts. I don't think he ever looked at a daily graph, a daily chart. He would only look at weeklies.
Wow.
And if you only look at weeklies, it might help you not to avoid shakeouts. I think probably one of the worst things we can do is have 5-minute charts and 10-minute charts screaming at you all day long because you think that the stock's rolling over and dying, but if you take a step back to the daily, step back to the weekly, you go, there's nothing wrong with this stock. So I think weeklies are very important to get the big picture. I even look at monthlies. Sometimes you can see the stock coming of a nice, huge base that you can see on a weekly or a daily.
Exactly. Well, David, thanks so much for joining us again. It was amazing. For those of you who are interested in MarketSmith and really learning this strategy and getting access to all of this great data, we're giving a 4-week trial for $29.95. Just give us a call, 800-831-2525, or you can just go on the website, investors.com/webinar offer, okay? So thanks, everyone, for joining us, and we will talk to you all shortly.